So the well-known ETF, XEQT, the question is buying XEQT enough, or should you be adding VFV and QQC for more growth? If you're in your 20s or 30s and you want to build some serious wealth, this video is going to break down 3 different strategies, and by the end, you will know exactly which portfolio fits your risk tolerance. So let's get into it. So first, let's talk about what XEQT actually is. XEQT is a single ETF that gives you exposure to the entire world. Inside one fund, you're getting 40% US, 27% Canada, 26% international developed market like Europe, Japan, and Australia. When you buy XEQT, you own over 10,000 companies across 50 countries. You own Apple, you own TD Bank, you own Toyota, all in one fund. So here's the important part. XEQT is 100% stocks, 0 bonds. That means when market crash, XEQT crash with them. In March 2020, XEQT dropped about 30%. So it has a maximum growth potential, but maximum volatility. Now that's the safe diversified option. But what if you want more growth? And let me break down the 3 ETFs we are comparing today. Option 1 is XEQT. You get the whole world diversified, safe, boring, and consistent. And historical return is about 8 to 10% per year. Option 2 is VFV. So this is Vanguard S&P 500 ETF, 100% US stocks. So just the top 500 American companies: Apple, Microsoft, Nvidia, Tesla, Google, Meta. And the reason people love and I love VFV is simple. The US has crushed every other market for decades. And option 3 is QQC. So this is Nasdaq 100 ETF. It is basically VFV with more tech exposure. So you're getting top 100 Nasdaq companies, which means it's heavily concentrated in tech. So Apple, Microsoft, Nvidia, Amazon, Tesla, Google, but way more focused than VFV. And QQC has historically returned 12 to 15% per year, but it has also been more volatile. In 2022, when tech were crashing, QQC dropped over 30%. So here's what I think about it. XEQT is the safest. It's global diversified, lower risk, low reward. VFV is higher growth, US focus, and single country risk. QQC is maximum growth and tech concentrated and maximum volatility. Now let me show you 3 actual portfolio strategy. So if you're a passive investor, your strategy could be just set it and forget it. 100% XEQT. This is a simple rule. You buy one fund, you set it and forget it. And you invest, let's say, $1,000 in a month into XEQT through your TFSA. You don't touch it for 30 years at 9% annual return. That becomes $1.8 million. So this is for people who want zero stress. You don't want to think about investing. Another strategy is that you can have 60%, let's say, XEQT, 40% VFV. And this is for growth strategy. You're keeping XEQT as your base for global diversification, but you're adding VFV to boost your US exposure. So if you're investing, let's say, $1,000 a month, 600 goes to XEQT, 400 goes to VFV. And expected returns around 9 to 11% annually. And this is for the people who believe in the US will keep dominating but want some safety. Another strategy could be XEQT be 30%, 50% will be VFV, 20% will be QQC. And this strategy is what I personally do and prefer. Because the reason is XEQT gives you the global safety net. VFV gives you the US growth. QQC gives you that tech rocket fuel. So if you're investing $1,000 a month, $300 are going into XEQT, $500 are going into VFV, and the remaining $200 are going into QQC. Now let's be very clear about something. This is most volatile option. QQC has dropped 40% in 2020. In 2022, it was down over 30%. But long term, 20, 30, 40 years, it crushed everything. This portfolio is for young people with high risk tolerance. If you're under 30, making good income, and you're okay with the swings, this is where you get the maximum growth. And expected return is 10 to 13% per year. But you need to be able to handle massive drop without panic. And that brings me to the most important part of this video. Your returns don't come from picking the perfect ETF. They come from not selling when everyone else panicked. Let me give you a real example. March 2020, the COVID crash. In the crash, XEQT dropped about 30%. So everything was dropping, even the big blue chip stocks, Microsoft, Apple, everything was dropping. VFV dropped about 34%. QQC dropped about 40%. Now, there were many investors, many young investors, they thought everything is going to stop, economy is going down. So they sold everything. Let's take example. Investor A has a perfect portfolio, 30% VFV, 20% QQC. So that looks great on paper. And they are well diversified, they're growing, they're going with the market without any stress. But what happened? Market crashes, their account is down 35%, let's say. They panic and they sell everything. So they wait for the bottom, they miss the entire recovery. And the final result is they lost money. Now another investor, investor B, they just had 100% execution. They just less optimal on paper, it's less diversified, and market crashes. Their account is down 30%, but they feel sick, but they hold. They keep investing every month, they're buying the dip automatically. Final result, they're up 80% by 2024. So the question is, who made more money? The boring one who didn't quit? And the answer is the boring one who didn't quit. So here's what you need to ask yourself. If your $10,000 become $6,500, let's say tomorrow overnight, would you keep buying? Would you hold and ignore it? Or would you panic and sell? So what my personal experience of 8 years of investing in stock market is that the best portfolio is the one you stick to. And my honest recommendation is that if you're young, aggressive, and want maximum growth potential, go with the 50% VFV, 30% XEQT, and 20% QQC for tech exposure. That's what I do personally. I own other blue chip good growth stocks. Like recently I invested some money in Irene, in SoFi, but that's what I personally do. So I'm young, I have time, and I can handle the swings. But remember this, in the stock market, in investing in anything in real estate, consistency beats optimization. The best portfolio isn't the one with the highest theoretical returns. It's the one you actually hold for 30 years. So if this was helpful, hit that subscribe button. I break down Canadian growth investing every single week. And drop a comment below. What's your strategy? Are you buying XEQT? What kind of ETFs you buy? And thanks for watching, and I'll see you in the next one.